The beauty about indexing is you never miss an Amazon or an Apple. And the bad thing about indexing is you never miss having a lot of overpriced stocks into one of the relatively rare bubbles, such as we have now. So it's kind of good news, bad news. If you can ride out the odd 50% decline, totally unnecessary, of course, on fundamentals 30 years ago. The market is mildly hysterical from time to time, and it's totally unjustified by the steady stream of dividends and earnings. But it happens. And if you want to ride those 50% drops, good luck. It works out very well in the long, long run. But it can take you 20 years to get back in the game. If you get caught in 1929, it works out just fine, but you don't get your money back until 1955. If you get hammered in 74, you don't get your money back until 87. And then when you've gotten it back for a month or two, you give it up again. And the same in 2000. By 2010, you're still losing money. So you have to be willing to ride out. And some people feel their lives aren't long enough to take the 10, 15, 20-year wipeout. So for those who feel they're brave enough and willing to try, I've always thought that sidestepping some of the pain might be a good idea. I think they're perfectly straightforward. They're intellectually easy and psychologically disastrously difficult. They're easy because in most cases, they're so extreme. It's like, how do you notice the Himalayas when you're standing in northern India? I mean, they come out of the plane and they soar up. You can't miss these things. 1928, 29 was just such a massive rally. So the sheer price rise, you can't miss. Secondly, just to make it easier, the great bubbles have always tended to rise faster and faster towards the end. And that's a kind of defining feature also. And then thirdly, they have all been accompanied by massive public, obvious, crazy behavior, where the headlines migrate from the financial page to the front page, where they migrate to the opening few sentences of the evening news on the radio or the television. And they talk about market new highs, and they talk about what the Bitcoins of the era have done. I know it's not a stock, but it's a speculative instrument, and the GameStops of the world. And back in 2000, most of you will be old enough to remember the pet dotcoms and the utter craziness of that period. And the same was true of 1929. The same was true of Japan. We had a group from Salomon Brothers, a leading American brokerage house of the era, who came around in 88, 89, when Japan was moving to 60 times earnings, and explaining that their yields, et cetera, and their interest rates, et cetera, they really should have been selling at 100 times, and they were cheap, and you should buy them. And it didn't stop the Japanese market breaking the following year. It has not recovered the high of 31 years ago yet. So that was pretty painful. It taught us, in a sense, a powerful lesson about how human behavior works. But it also explained to us why the big firms couldn't play that game. It is simply not a commercial proposition to get out of a bull market, because every now and then they run further and faster than you expected. Japan went on and on and on, way beyond people's expectations. 2000 beat the record. There's a lot of difference between 35 times earnings and 21, the previous record. So sometimes they break out to an astonishing degree. Now, the bad news is that changes nothing. They go back even more and longer, and they go back where they came from. And the higher they go, the harder and longer they fall. But it changes everything when you're there. When you're having a bubble, it's really advisable to have the bubble be in one focused area. In 2000, for example, it was US growth stocks. It was not global. And real estate was really cheap, as in cheaper than the cost of building the building you could buy real estate for. Bonds were really cheap, and inflation-protected bonds had just come out, and they yielded 4.2%, 4.3%. I mean, can you believe it? Real return guaranteed against inflation. Even within the market, the value stocks were not too bad, and the small stocks were not too bad, and small value was actually cheap enough that when the S&P had gone down 50%, it hadn't gone down at all. It was, I think, +3. I mean, amazing. And the REITs, all of the real estate, they were up 30% as the S&P hit -50. That was a bubble that was paradise for an asset allocator because there were so many alternatives. What you want to avoid is what Japan did in 89. Japan had the biggest bubble in history, I believe, bigger than the South Sea bubble, and that was in land and real estate. And the old story, the land under the Emperor's Palace was worth more than the whole state of California. We spent 2 days actually asking and digging, and it was. It literally was. First of all, it's a big palace with great palace grounds. And secondly, downtown Tokyo, all around it, was selling for, 4, 5, 6 times downtown Manhattan. And the numbers worked out. Just amazing. Simultaneously, they had the biggest equity bubble of any important market. There are some flaky, tiny markets that don't count. But of any major market, that's the biggest bubble of all time. At the time, we were told it had gone to 65 times earnings. There's always historical revisionism in the data, so you have to be a little careful. But at the time, it was clear, everybody agreed, 65 times earnings, which is pretty remarkable. And it had never sold at over 25 times before. So that's the thing that makes every value manager wake up sweating in the middle of the night, is Japanese stocks. Anyway, they managed to do both of these at the same time. And 31 years later, the land is not back, real estate's not back, and stocks are not back to where they were. This was a loss of perceived wealth so profound that you have to congratulate the Japanese for not going into a depression. And people talk about a lost decade, but that was a lost decade where they actually inched forward. They actually did not go even backwards for the decade. When you're taking that kind of loss of wealth, you're in trouble. Now, in the so-called great financial crash, which irritates me as a title because I think it was a housing bust, the housing market had this perfect 3 sigma, 1 in 100-year outlier bubble. It had been very, very stable historically. So to get to that level, it only had to go up only, he says, about 40% or so in 2 to 3 years, which it did. And then it gave it all back. But the trouble with 2007 housing bubble is it took the stock market with it. The stock market was not sensationally overpriced, but it was a big overpriced bull market. It was not in itself a bubble. The housing market was a bubble, a beautiful, magnificent bubble. And if you look at it, it's perfectly round. It goes up for 3 years, it goes down for 3 years, exactly the same speed, and it goes all the way back where it came from. And the housing bubble inflicted about $10 trillion of loss of perceived value. So 1 minute you thought your house was worth 400,000, 3 years later, you were told it was worth 550,000. 3 years later, you were told it was 400,000. And 2 years after that, 350,000. So you had lost an enormous asset. And housing markets are much more dangerous because more people own them. The middle class in particular that owns very little stock owns a lot of housing. And it really, when you lose that value, you skip the trip to Portugal and you realize you can't send your second son to private school. And it really flows through the system. Don't do it. So what do we have this time? We have, of the 4 major asset classes on the planet, we have 3.5 in bubble land. We have, Jim Grant would say, the most overpriced bond market and the lowest rates in the history of man that go back 4,000 years. There was never a time when so much had a negative return where you pay the government to take your money. So that's number 1. Number 2, we're a contender for the highest priced US equity market in history. I would say a majority of bubble experts think this is now slightly higher than 2000, which was epic. And some people do not, but at least we can all agree it's a contender. And then we have real estate. And real estate was kind of off screen until a few minutes ago. And suddenly, on some of the databases, it has risen 20% in the last 12 months. As Schiller's series, a little more conservative, lags quite a bit. I think it's only up 13, but the other series, perfectly seriously done. Up 20 is the sharpest rise, sharper than the 70s with inflation and sharper than the housing bubble of 2005.